Good morning, everyone. This is Anna Sergunina and
Jim Ludwig.
yay, this is live with Jim and Anna, and we're here for questions. I hope everyone is doing well. You probably saw the little headline in the title for our show. So we've got some news, but first we want to get to the questions. Jim, how are you doing today?
I'm doing good. Where are you at, Anna?
I'm in my home office.
Aha.
How about you? I know you've been on the road for some time.
Well, I'm in the Santa Barbara office in our conference room.
Sounds good. So Jim, I heard you relocated.
Well, I drove a truck with all our worldly possessions to Las Vegas, where we bought a house a few years ago, and that's going to be our retirement home. I'm not exactly retiring, but I'm going to do like you did, Anna, a few years ago. I'm moving to the West Coast, although not all the way. But
Yay.
I'll just be flying back to the East Coast 1 week a month, just like you do. And, we'll be world travelers and have a lot of frequent flyer miles.
I know, and now I have you on the West Coast, Jim. That's interesting. I actually this month is 5 years for me since I've moved to California. So
Wow.
5 years went by really fast. Well, now let's get to some questions, Jim. We have quite a few in the pipeline. So you want to go first? I'll ask you a question.
Okay, go ahead and ask me a question, Anna.
Okay, here's a question. Should I plan on using my home equity in retirement? I just recently read something in the news.
Yes, one of our clients sent us this article that appeared in a national publication that people should consider using their home equity during retirement, either extracting it via a home equity line of credit or a reverse mortgage. The article featured home equity lines of credit, but I think people should also consider a reverse mortgage where the lender gives you a line of credit, and that line of credit, if you don't use it, grows over time. And the differences between a home equity line of credit and a reverse mortgage line of credit is when you start using the home equity line of credit, you have to start making payments.
Mm-hmm.
With the reverse mortgage line of credit, you don't have to make payments ever. In fact, there's no requirement to make payments. The value or balance of the loan just grows, and either you or your heirs have to satisfy the mortgage 1 year after you vacate the property. However, if you're under age 62, you won't qualify for a reverse mortgage line of credit. And if you own the property as a couple, both of you have to be age 62 or above. And there was one horror story I read a few years ago about only one owner was over 62. So the younger one quit claimed the deed and got off the deed. And then the older spouse died, and the bank forced them to sell, even though the survivor was still in the house, because they weren't party to the home equity the reverse mortgage line of credit agreement. So there are very specific peculiarities about reverse mortgages. So the government mandates people get counseling to preclude issues like that. But yes, you can use your home equity in retirement. There's a couple of ways to do it. You could sell the property to your kids and get a life estate. So there's a lot of ways to use your home equity, but you've got to be careful, and that's what financial planning is all about. So an article in a famous newspaper may not be the final recommendations for everybody.
I also heard, Jim, and I think I attended a seminar or webinar on this not too long ago. The cost of putting a reverse mortgage is kind of costly up front. So it turns up a lot of people at the beginning, but I think it's the whole market space is changing because people are needing this benefit and want to get it, but nobody wants to pay $10,000-$15,000 up front. So it is. I know that space is changing. So let's hope that more people use it because the rates are low. So
that's for sure.
Those are my 2 cents.
Okay. Well, how about a question for you, Anna?
Let's do it.
Well, one of our clients wrote in and said, should I cash out my traditional IRA to help pay down my student loans? I just graduated from college and I've got $36,000 in student loans. My IRA balance is $10,000.
Yeah, well, Jim, you can always cash out your IRA, right? Nobody said you can never do it. However, if you do it before you're 59 and a half, then there are going to be penalties for early distribution. You always pay taxes anytime you take money out of the traditional IRA.
Yes.
So looking at this question and thinking, okay, we have $10,000 in this account, right? And if we were to just completely cash it out, and I'm assuming that this client may be in the 20% tax bracket. So that's 20% for taxes, right? And 10% for penalty. So out of the $10,000 balance, we will be needing about $3,000 in taxes for taxes and penalties.
Right.
So at the end of the day, that's like 30% of your IRA balance. And you're telling me your balance on the student loans is 36. So that gives you not very much to pay down, right? And then you're going to be depleting the IRA that could potentially grow to a big chunk of money by the time you reach your retirement. So I'm not too thrilled to support this idea of cashing this IRA. It isn't going to help you pay down the loan that much. I would suggest that if your rates are high, I'm not sure what the rates are on the student loans, but what I've seen lately with my clients, 5 or 6%. That's kind of where they are right now. How about looking into refinancing? There are interesting companies out there that, for example, SoFi, Incredible, and actually 2 of my clients are going through refinance, one with SoFi and one with Credible. It really depends on what kind of loans you have, what kind of rates you have, what your credit history is. So I can't speak for one or the other, but I have 2 clients who are actually going to benefit from both organizations for reducing their interest rates. So I think that's probably a better approach than tapping into your IRA. I would suggest that you put more money into that IRA account if you can, but not with the balances you have, and it just isn't going to make a huge impact on the overall plan.
Very good thoughts, Anna. Very good thoughts.
Thank you, Jim. How about another question for you?
Well, let's remind our viewers that we'll take questions live if they go to the Q&A block that appears on the screen.
Well, wait a minute. That's a Q&A block for you and I, because we're on this Hangout. For our viewers, on the left-hand side at the bottom of your screen, there's a little yellow link. And I think you click on it, and it brings you to a space where you can put in the questions.
Right. And I've got it up here where I can see if people write in. That's what I was referring to. Anyway.
Right. I don't see anything on my end. So we'll just continue on with our questions. Okay. All right, here's a question for you. I've been paying now about $550 a year for a home warranty plan for the past 8 years. Should I continue paying or just save money for my new HVAC system in the future? Because I think that might be my biggest expense.
And home warranties probably came around as an insurance product maybe 30 years ago, where new buyers were moving into a house and they weren't sure how long those appliances were going to hold up because they were used. And so the seller would buy, in most cases, an insurance policy called a home appliance warranty plan and give that to the buyers as sort of a reassurance that they wouldn't have any immediate out-of-pocket expenses. The industry, though, thought, gee, maybe we can renew this policy every year for these buyers, and we'll make a lot of money as profit. I think that was their business thinking. But as a consumer, I think people have to look at it and say, do I need to lay off this risk to a group by buying an insurance policy, or do I self-insure and save for the eventuality where I might have to replace the washer, the dryer, the refrigerator, the dishwasher, or, and in the case of our client, a heating, ventilation, and air conditioning system. So my response to that kind of a question is drop the home warranty and save for that eventuality of replacing heating, ventilation, air conditioning system. The last time I replaced one a couple of years ago, it cost me $9,000. Well, she's paid in, this client was a lady, she's paid in almost $8,000 in premiums over those years. No, excuse me, almost $5,000 in premiums over those years, and really hasn't had any claims. So I think it's a more prudent decision to self-insure in this case and save for that new HVAC system or the refrigerator or the dishwasher or anything else that might break down. A home warranty plan does not usually get you a new appliance, by the way. That's paying for the repairman to come and fix it. So you may still be stuck with that 10-year-old dishwasher repaired and not a brand new one that might be quieter. Okay, so just my 2 cents there.
Yeah, that's what I thought about. That's what I knew about these insurance policies. They don't get you a whole new whatever appliance you need. You just get it replaced. And so then I think I agree with you, Jim. Save the $550 in your own savings account for the repair.
And for any kind of insurance, it's a matter of risk. And if you can self-insure, you're playing insurance company with yourself and you get all the profits. So that's with life insurance, when you need 500,000 or $1 million, it's hard to save up for that much. Okay.
Sounds good.
Okay, Anna, here's one for you. I just purchased a new car. Oh, I wish. This is from the client though. I just purchased a new car and my insurance premium went up. What can I do to lower it back down?
Yeah, I like this question. Well, congratulations on purchasing a new car. My car is 10 years old, so I'm going from day to day thinking, okay, do I need a new car? Or any day I drive it and I don't drive as often, I think, okay, I'm ready for a new car. The next day I don't drive it, I don't even think about it. But anyway,
well, as your financial planner, we'll have to discuss that offline.
I know I have to consult with my financial planner. But okay, going back to the question about, okay, you've got a new car and an insurance goes up. Well, I think it's a typical event. So let's talk about what automobile policy generally covers when you've got a car. So if you want to dig up your policy and you're listening to this question and reply, that might be helpful, but you could go back and look at it later. So automobile insurance policy has a few sections, and you can look at them, that covers different types of events. So the one that I'm going to be discussing right now has to do with if something were to happen to your car. And so that has to do with collision. So when you look at your policy, okay, and it's usually typically not at the very beginning, but maybe middle section of the policy, look at something called collision and comprehensive. So I'm looking at collision coverage, okay? So collision coverage covers your car if you had an accident and it was destroyed in an accident. So they'll replace your car. When you have a new car, well, typically the value of it is more. So therefore, if you look at the premium, so you'll see the collision listed, and then you'll see a premium that's associated with that type of a coverage. Well, when you have a new car, that's usually comes out to be second most expensive part of the overall policy, the number one being liability, but we're not talking about liability. So as many policies as we review for our clients, I frequently see that a lot of clients have low deductibles. And I think it's just not really fully understanding how the policies work. So if you have $100 or $250 or $500 is the most typical deductible that I see, and your car is fairly new or brand new, I would propose that, just like what Jim was describing in the question before, I would propose that you tell insurance company, hey, I'm willing to take a little bit more risk by increasing my deductible to $1,000. And therefore, you need to reward me with lower premiums. So you tell them that you would like to increase your deductible from whatever it is right now, 250, 500 to 1,000. 1,000 seems to be sort of a sweet kind of spot. It also has to do with, do you have $1,000 in your savings account? How's your emergency fund doing? In case there is an issue and there's an accident and you need to come up with that $1,000. Okay, so insurance will pick up after that. Now, I have a personal example, okay, with my 10-year-old car now. So about 6 years ago, when I went from doing that, the car was maybe 3 or 4 years old. So I said, okay, I'm going to go from 500 to 1,000. Okay, so I increased my deductible, and my premium savings were about $160 a year. Well, I mean, it's not $160 a year is something that I don't have to spend on insurance. Now, I thought, okay, if I don't have an accident, I don't have to file a claim, not necessarily accident, but maybe a small fender bender, for the next 3.5 to 4 years, then I will come out ahead, right? Then I actually saved that $160 that I didn't spend on insurance. And so I have not had an accident, haven't had to file a claim, so I'm still doing good. The car is still around, but I've seen this quite often when we recommend to clients to go to 1,000, anything more than 500. That definitely works with your premiums. Jim?
Great. That's good. And I don't have anything to add there, Anna. You covered it quite thoroughly. Nice job.
Thank you. We have maybe 1 minute. Do you want to take another question?
Real quickie if you've got one.
Okay. All right. Let's see. If I change a 529 college savings plan from one state to another, do I have to pay taxes or fees?
No. That was a quick answer.
You want to elaborate on that a little bit?
Yes. If you didn't take a state, most states do not have a state tax deduction. 17 states do. If you get a state tax deduction like I did in Maryland, and then I changed it over to the Nevada plan, I would owe money back to Maryland. I'd have to repay that state tax deduction. So sometimes there is a penalty, but if I keep it in Maryland, then there is no penalty. In this case, the client was following my advice to go to Utah because she's in a state where she doesn't get a tax deduction, and Utah uses Vanguard funds, so it's very inexpensive. And she saw the wording about if you change from Utah, then you could have to pay some money back to the state, but that was only directed for Utah state residents. And so she then realized, oh, that's not my category because I live in another state other than Utah. So you just have to look at the terms and conditions like most other products that you buy as a consumer to make sure you understand the rules. So switching from one state to another state in most cases does not involve any fees or any taxes due back to the original plan provider.
Yeah, I also wanted to add one cent here is that sometimes I've seen plans that don't associate with any states at all. So if you go to Vanguard directly, you can open a 529 plan.
Sure. And if you go to USAA, you can do it, or MOAA. USAA is a military insurance company, and MOAA is the Military Officers Association. There are about close to 100 529 plans, and we know there's only 50 states. So,
right.
Yes.
Right. Well, we do like Vanguard, and so happens that Utah uses Vanguard, but you can go directly to Vanguard, get the plan. Well, Jim, we're right about out of time, so we had a special announcement we wanted to make. I know you were a little sad that you just told me this before we started the show, but please don't be sad. It's actually it's good. It's the new beginning. So we've had 25 episodes. Do you know that?
No, I didn't.
Yes, we've had 25 episodes.
That's over 2 years.
I know. I was looking at it the other day. So anyway, we are introducing a new show. So Live with Jim and Anna is going to phase out slowly. Right now that I know you're a little sad, maybe we'll continue from time to time. We have Main Street has grown, and so we have new members that we want to bring on and just kind of expand in that direction. So the new show that's coming out, we're still working with the title, but potentially it would be Live with Main Street. So then you can still get to interact with us and hear us answer questions, but we'd like to bring our new team members and see how that goes. So that's kind of the special announcement. And we are slowly phasing out Live with Jim and Anna after 25 episodes.
Oh, I thought you were going to announce we're opening an office in Italy.
Oh my God. No, Jim, you're going to have to work remotely.
Oh, okay. Well,
so yeah.
Anyway, I was just thinking that was it.
That was it. Yeah, that's for the next show. Okay, well, we're a little over time. Everybody have a great weekend, and we'll see you soon, either Live with Jim and Anna or Live with Main Street. Take care. Bye, Jim.
Bye.